I don't know if you've watched nickel and the nickel stocks in the last 30 days, but it went from probably still hated, but at least interesting. It went from no bid to strong bid. So that's important. But it's nowhere near as much fun as a check writer now than it was in 2020, 2021. There was lots of stuff that was hated. The silver juniors were hated. Now the market's ecstatic about them. The uranium juniors, it was as though all the people who were intrigued by uranium at the end of the last decade suddenly forgot how to spell it. But that's all gone. The extraordinary hate, which I enjoyed so much 5 or 6 years ago, is out of the market. It's difficult for younger people to understand. But arithmetically, a market like silver, which has doubled, is half as attractive. I mean, this is really pretty simple math. The silver price had to go up, and it did. So it doesn't have to go up anymore. It can go up, but it doesn't have to go up.
Oil and gas sector that you mentioned is hated. We're seeing a lot of bearishness in the markets, also a lot of bullishness going around. From a fundamental perspective, Rick, where do you think we are currently located on the cost curve? Are we already seeing, with the current prices in oil around $60 a barrel or a bit lower than that, some producers having to close doors?
They're closing doors as much as they are cannibalizing themselves. The response that you're seeing, particularly among the mid-cap producers, has been to defer sustaining capital investments and new project investments in favor of raising the dividend and doing share buybacks, which is to say they're cannibalizing their future growth. The global industry, including parastatals, importantly, is estimated to be underinvesting in sustaining capital investments by between $1 and $2 billion a day. So make no mistake, this deferral of sustaining capital investments impacts the company's ability to produce in years like 28 and 29, maybe not 26, but it's structural. If you defer sustaining capital investments in 6 years, you can't make it up in 6 months. That's not the way it works. You may remember, because it's fairly recent, the price hike that we enjoyed in the oil and gas business after COVID. The oil price fell to, well, briefly to zero, but settled out at $20. Now, that was strange because the structural break even for the oil and gas business, including cost of capital, was 60. So you make the stuff for 60, you sell it for 20, you do it 95 million times a day, and eventually it begins to hurt. And sure enough, it hurt. The oil price didn't go to 60. It didn't go to the economic clearing price. It went to 90 or 100 because markets overshoot. That's what markets do. Well, I believe a few things. The predominant new supply player in global oil markets for the last 15 years was the United States. Our shale plays, the convergence of these wonderful American technologies, three-dimensional seismic, better wireline logging, horizontal drilling, measurement while drilling, multi-stage fracturing, all these things kicked off a tremendous boom in the United States. That boom at this price is crested. It is estimated that in the United States, 85% of our tier one locations, the best locations, at today's prices with today's technology and today's interest rates, have been drilled. The rig count is very low because at $55, U.S. producers aren't making any money. And around the world, particularly in trouble spots, Mexico, Venezuela, and Russia, there's a huge deferral of sustaining capital investments. And that will bite. There's no way out of it.
And Rick, where are you finding the most value in producers currently? When you look at the chart of a lot of producers, it hasn't gone down as much as one would expect with how the price of the commodity itself looks. So where are you finding the most value?
If I had my choice, my druthers, I'd be buying the Russians. I love hate. And there's no place in the world more hated than Russia, even among Russians. But because I have a banking organization in the United States, the compliance complexities of me investing in Russian oil and gas would be counterproductive. But, to answer the headline question, I would invest in Russia were I not an American. Even as an American, I might do it if I didn't have a banking organization. When there's as much beta as we're going to see in the oil business, you don't need to be too speculative. You just get in the middle of the trade. And from my point of view, the best place to be in the middle of the trade is Exxon. Now, last 3 days, as a consequence of the theater in Venezuela, the share price of everything oil and gas is up by 10 or 15%. I would expect the furor of that to subside. I'm not a news trader. But if Exxon were to retrace, I think Exxon is selling at a 25% discount to its net present value at $60 oil. And I believe in 3 years we're going to see $85 or $90 oil. I believe, too, that Exxon's investments in Guyana, they're so big that they're going to move the dial on Exxon. So far be it from having production declines, they're going to have production increases. Finally, they are likely the largest, or if not the second largest holder of undrilled Tier 1 locations in the United States. They have been making the sustaining capital investments that others have been deferring. So I think I'm buying a company where over 5 years, the net present value at least doubles, maybe triples. And I'm buying that at a 30% discount to current net present value and enjoying a 2.75% dividend. That's pretty attractive. If you have more courage, if you're younger, if you have better knowledge of technology, the oilfield services business likely goes crazy. I'm not saying that things will settle out in Venezuela and that the industry will be able to invest $100 billion there. But if they do, the oil field services companies, where their capabilities are already stretched, are going to make a fortune. Ex-Venezuela, which is, say 2 weeks ago, what you looked at is the fact that the oil industry needs to make up for deferred sustaining capital investments over 5 years to maintain current production in the next 5 years, even while oil and gas demand grow. So the service sector, the Halliburtons, the Schlumbergers, those people, for people who have a deeper understanding of technology, probably a better play than the oil and gas producers. I stick to the simple stuff. I don't do technology and process much, although I must say I'm a reasonable sized shareholder of Schlumberger. I wanted to buy the best of the best, one where you didn't have to be too smart. I know that a lot of your audience traditionally has been Canadian, and I would be remiss if I didn't say that the Canadian oil and gas sector is at least equal in quality to the U.S. sector, probably better because they have a larger number of undrilled Tier 1 locations. And they're cheaper. The risk in Canada is, of course, the political establishment. I suggest that Mr. Carney is an improvement over his predecessor in only that he can add and subtract and multiply and divide. He's numerate, whereas his predecessor was rhetorical. But he's anti-carbon. He said that his financial decisions will be made based on carbon, which is not a friendly statement to the oil and gas business. If you believe that markets are ultimately bigger than governments and that Mr. Carney will have to be pragmatic to fund his idiotic spending, then you look north of the border. You look at names like Canadian Natural Resources, which is sort of a poster boy for Canadian oil and gas. You look at Suncor if you have the courage. If Venezuela did come back on, it could be deleterious to Suncor over 5 years, unless Suncor was able to participate. You look at names like ARC, Tourmaline, Prairie Sky, Freehold, Peyto, Birchcliff. You buy that and you get in excess of a 6% current yield, and you get discounts that are even deeper than the American discounts. But you get it with real political risk.
What a phenomenal overview of the oil and gas sector, Rick. And like you outlined, it's an interesting, hated sector currently, and you're getting paid to wait. I would love to talk about some other commodities that are currently hated. The commodity complex is quite vast, but it's hard to find a few. Is there anything that's on your radar that's currently hated enough?
Had we talked 4 months ago, I would have said nickel. The nickel market was flooded by the Indonesians. Mercifully for me, 2 years ago, I flew over southern Sulawesi, the Indonesian nickel fields. And looking out the window of the plane, I was absolutely shocked at the environmental devastation I saw. Nobody's going to mistake me for Greta Thunberg, But I need to say, it was apparent to me that that level of environmental devastation would cause repercussions among the Indonesian citizenry and even the Indonesian politicians. And that's begun to happen. If you mine laterite nickels responsibly, which can be done, the primary cost of production goes up by 25 or 30%. By the way, even if you don't, if the energy prices go up the way I think they will, your costs rise too. And that's begun to become apparent to the market. The Indonesian government has not merely made noises about environmental devastation, they've sent in troops. And the nickel market's taken notice. I don't know if you've watched nickel and the nickel stocks in the last 30 days, but it went from probably still hated, but at least interesting. It went from no bid to strong bid. So that's important. But it's nowhere near as much fun as a check writer now than it was in 2020, 2021. There was lots of stuff that was hated. The silver juniors were hated. Now the market's ecstatic about them. The uranium juniors, it was as though all the people who were intrigued by uranium at the end of the last decade suddenly forgot how to spell it. That's all gone. The extraordinary hate, which I enjoyed so much 5 or 6 years ago, is out of the market. It's difficult for younger people to understand, but arithmetically, a market like silver, which has doubled, is half as attractive. I mean, this is really pretty simple math. The silver price had to go up, and it did. So it doesn't have to go up anymore. It can go up, but it doesn't have to go up. I found at my age that asking myself a question where the answer begins with when, as opposed to asking myself a question where the answer begins with if, means I'm asking myself better questions. So 4 years ago, the question is simply, when is the silver price going to go up? When are the generalist investors going to be intrigued enough about the momentum in the gold price that the love changes to silver? And when will the better silver juniors cease to be hated? It really was a when question. Now, with the silver price double, and with the price of the best silver juniors up 400 or 500%, the question is, can it increase? If there's an increase, what will happen? It's no longer a when question, it's an if question. I happen to believe that the answer to the if question is yes, but that doesn't matter. My level of certainty around a when question and my propensity to write checks around a when question was very much higher 4 years ago than it is today. For most people, they require affirmation from price to justify a narrative. The problem with waiting is that most of the benefit of the narrative is gone because the prices are up.
Excellent. And for coal, thermal and metallurgical coal, what is the question now currently? Is it an if or is it a when question?
Certainly a when question. You have to have some courage. The reason that I say you have to have courage is that the best coal producers aren't necessarily coal producers. They're multi-commodity producers. So finding a pure play in coal, finding a company that is in a hated commodity that's in the best cost quartile worldwide and the highest return on capital employed worldwide is impossible. The best coal companies aren't coal companies. They're diversified commodity producers. If you have the courage to play on the margins, coal's a wonderful place to be. The largest year on record for coal demand, on record, was 2025. And it will certainly be eclipsed in 2026. So all of these people talking about the death of coal are people that neither look nor think. You may or may not believe that we should be at the end of coal, but poor people in places like India or Madagascar that want the lights to go on when they flip a switch, burn coal.
I believe earlier in the interview you mentioned that you view copper as a coiled spring. Of course, it's currently trading very close to all-time highs. Are you viewing copper as a when question? When will it go up, or is it an if question?
When? Again, in the near term, some of the tension on that spring has been released.
Yep.
But copper has a long way to go. Again, this is a metal where the utility of copper relative to the price is extraordinarily high. What people like you and I, wealthy Caucasian people in Western countries, think about is AI and Teslas and little Apple products and stuff like that. They forget that there's still a billion people on Earth with no access to primary electricity. And we're going to solve that problem in the next 20 years. We've done a wonderful job in the last 40, raising the material standard of living of the poorest of the poor. A spectacular job. Hats off in particular the Chinese for urbanizing 500 million people. Spectacular job. We're going to finish the job in the next 20 years. It's going to require a lot of copper. But it isn't just a demand story. We have underinvested in copper as a species, as an industry, for 30 years. We've underinvested in exploration. We've underinvested in construction, production. We've overinvested in regulation and delay and tax and royalty. And there's no way in the world in the next 5 years that we can make up for 30 years of underinvestment. We can't do it. And when we invest, here's an example. In the U.S., there's a wonderful undeveloped copper deposit called Resolution. I've been there. It's spectacular. Grade 1.5% copper. Median mine grade worldwide, 0.4. So this is 3 times the average grade worldwide. Over 1 billion tons. It's got a great location. It's between a couple of copper mines. Nice place for a copper mine, right? Highway going across it, rail going across it, water, power. A couple of towns nearby full of copper miners. Couldn't get better than that. And the thing has been in permitting for 28 years. So depending on where you find it, even if you find a good copper deposit, by the way, you have to go look for it. You have to drill it out. then you have to permit it. The average time from the indicated discovery of an economic deposit to production, according to the industry, now exceeds 15 years. So let's say for fun that we could go out and find a bunch of good deposits in the next 5 years. Of course, we have to look for it. It won't impact supply for a long, long, long time. And the other thing that happens, if I'm right about the real rate of inflation, is that the cost of building the physical infrastructure to mine copper is going to go up very, very, very fast. So what is today a $5 billion bill around a porphyry new build in the Andes, in 2026 becomes a $6 billion build, and then a $7 billion build, and then an $8 billion build, in an era where the long-term interest rate is going up, despite the fact that the short-term interest rate is going down. So the capital budgets increase at the same time that the cost of capital increases, and importantly, at the same time that government theft, royalties, uncompensated offsite improvements, taxes increase. This is an if, not a when. People don't understand the value of incumbent, built, permitted, long-lived producing assets.
Your thesis is well understood, Rick. Incredibly interesting. What are some of the best names to start researching in the copper sector?
I think you start at the top. For people who have the courage, and it takes courage because there's political risk, I think you look at Glencore. They're really good in the coal business. They're really good in the copper business. They are, I would suggest, the smartest of the major miners. But there's political risk. There's a lot of emerging markets assets, and there are a lot of assets that there are allegations were acquired by means that are no longer legal in the United States. I'm not smart enough to tell you if that's true. I think you look at the merger between Teck and Anglo, where some of the Anglo shareholders are selling off because they were looking to be taken over by BHP, and some of the Teck shareholders are selling off because they were looking to be taken over by BHP. In other words, there was a disappointment around the merger. So I think you look at a circumstance like that where you have a pretty good range of assets and where you have the ability, I don't know if they do it, but you have the ability to reduce G&A substantially. You know, there's two sets of management teams there. You need to make one. You know, so I think that's a good name. I'll make my friend in Peru very angry with the next thing I say. But I think you look at a little stock, if you want to, called Amerigo. It's up by 200%, and he thought it was funny that I made it a top pick. If you look at Amerigo's production profile, they've got at least 30 years of reserves left. They don't have to permit the mine. It's built. The stock is up by 200%, but I would argue at today's net present value, the value of the company is up by more than the share price is up. Now, you have to have the courage to buy a marginal producer here. It's embarrassing to me, actually, to mention Amerigo in the same breath as I mentioned Glencore. But it's an important teaching tool, much as we talked about earlier. Agnico Eagle's net present value at today's gold price being higher relative to the share price than it was 1.5 years ago when the share price was half as high. People don't understand the juxtaposition between the price and the value of something. And it's important to understand the whole equation.
Last commodity I would love to squeeze in for a second is tin. It's something we don't hear a lot about. A viewer actually requested this, that I specifically asked this to you. So what is your opinion on tin, and how does the landscape look like?
The horse is out of the barn there. You know, the tin price was really in the toilet 2 or 3 years ago, and it's no longer in the toilet. It is absolutely an essential metal in electronics fabrication. In anything you do, all those little tiny microcircuitry joints, you know, they're all put together by tin. Tin is in everything. And tin supply is relatively constrained. It's difficult to find a big tin company or a sole focus tin company. I have expressed my fondness for tin by accepting extraordinary political risk and owning a company that produces in Congo called Alphaman. I've owned it since before it was public. Now, this exposes me to ugly, ugly political risk. This is in the most troubled part of a troubled country. This is in an area where warlords and bandits are commonplace and where the company has to ship truckloads of concentrate worth $500,000 each across rural roads. That'll give you a sense about the risk. It's also the best tin deposit in the world. I'm not suggesting that your viewers buy Alphaman. I'm suggesting if they do, that they sell their television, So they won't ever be able to see news coming out of the Eastern Congo, which will, if it doesn't scare them, scare their wife to the extent that there's no amount of money that can be made that will compensate for that. But I own it because I sold my TV.